a very warm welcome to the On the Tape podcast. I'm Guy Adami, always joined by Danny Moses. Danny, how are you?
Hi, Guy.
3 and 7. Dan Nathan, how are you?
Doing great, because I took one off him last week.
Keep it going, Dan.
Yeah.
Today we're in for a treat. We are joined by Dan Greenhaus. He was last on with us January 12th. I would say 90 to 95% of the things that he talked about them have come to fruition. So somewhat prescient his calls then. We're going to see where he stands on things now. By the way, Dan is the Chief Strategist at Solus Alternative Asset Management.
Is this not called Three Dans and a Guy?
Ooh.
Is that what this
only
is?
Dan's
Well, there's
and
Dan,
Guy.
a Dan,
Only Dan's and Guy.
Only Dan's a Guy.
By the way, the three of us, the two Dans and Guy, we sat down with Vincent Daniel earlier. He will be on the On the Tape podcast that drops on Monday in your favorite podcast store.
Great combo. He's the man.
He's the man. They just had a little Syosset reunion in here.
I love him, and I think everyone
Syosset.
should listen.
Syosset, Long Island.
Yes.
That's like central Long Island-ish, right?
A little north central.
North Central. Dan, how are you?
I'm doing wonderful.
Dan
Thank you.
Greenhaus. So this is one of those shows where I have to actually
Bring him in right
bring
away.
him in. Well, we have to bring him in right away, but I have to say his last name because when you have a
A
number
lot
of...
of Dan's. So this is Dan Nathan speaking right now, if you're
Yes,
listening.
please.
So Guy kind of hinted to the fact that when you came in here in January 12th, it was kind of in the lion's den a little bit here, and you laid out a very optimistic view.
Aggravating.
Dan Moses, that was Dan
That was
Moses.
aggravating.
I come here with the sole intention of aggravating you
And
guys.
you were successful last time. But you were, you know what's even... You were successful and you wound up being right, which is a doubly upsetting thing.
yeah.
But again, that's why we have you on, because again, there's certain people on CNBC, when you see them on, when you look up and say, oh, you turn the volume up. Dan Greenhaus is
Well,
one
because
of
of
those
that
people.
voice. We were going to hear it in a second. The voice is...
the sultry,
So,
smooth
all right,
sounds.
we're going to get into it. Did you ever waver in your bullish outlook for equities this year? Were there
No.
any point? No.
Not this
Whoa,
year.
Whoa.
No,
Not even in early August.
no,
Not even in early September.
no,
Didn't have any second thoughts about anything.
never.
Didn't think I should have taken some chips off the table.
No. Who takes chips off the table?
Okay, just checking. I just wanted to see your moxie. Anyway,
He's standing in the pocket
okay.
where everything's around him going crazy.
Syosset's strong.
And
All
he
right.
sees the field. All right, so here we are. The S&P's making an all-time high. We're doing this on Thursday afternoon.
Into the close.
Into the close. 57.42. The all-time high was made earlier today, almost 57.70. There are a lot of reasons to be concerned. I know valuation isn't a timing mechanism. We've talked about Warren Buffett, and you can sort of opine about that. He has $280 billion sitting around. The Buffett indicator, which people point to, is north of 200%. Debt-to-GDP in this country is approaching 130%. There's so many things out
We
there
already tried
that are
this with them
scary.
last time. Yeah.
Yet you still think, and by the way, correctly, that there's some legs here.
Well, listen, everything that you just listed, we could have talked about on January 12th.
And
when
we
I was
probably
here,
did.
And the previous January 12th and the
We
previous
probably
January
did
12th.
that too.
And you probably did. That's right. So, I mean, listen, I think for investors out there, the most important point I would make that we've all talked about for years and years and years is everything you just mentioned is almost completely irrelevant from the day-to-day investment process. Debt to GDP, sure, it's high. I think it's disgusting and it needs to be addressed, but I don't think it's getting solved today, tomorrow, or the next day. And I don't know why it affects NVIDIA or Tesla today, tomorrow, or the next day. This is akin to the worries about Social Security funding, like all super important stuff that we need to address at some point. But in the current risk landscape, I don't understand why that affects the near term. I mean, listen, the issue is, well, if there's some sudden spike of interest rates,
Right.
if for some reason the world doesn't want to finance our deficit, then sure. But there's no evidence that that's going to happen, and none of us have any idea when it might.
Has it really just been, a chase? We've talked about this before. We talked about it in January with you. Just it's the sexiest game in town is the market. I don't necessarily think that the S&P 500 is the right mechanism to look at necessarily if you're trying to judge if the market is healthy or not.
Well,
because
what is?
Well, it's driven by, I would do the equal weight of the
Sure,
S&P.
which is still up 12% this year.
I'm just saying, it's not the be-all, end-all as the S&P
No,
500.
I agree.
I'm not saying that it shouldn't be used as, I'm just saying there are other ways to look at this market.
And by the way, just real quick, not to cut you off, I do think it is important. This is probably and I'm curious because we've all been doing this for decades now. I think this is the first time since the 2000 era where you would look at the Royal U, would look at the equal weight as a better barometer of the market. That's not to dismiss how important, and we all know NVIDIA, et cetera, we know how important they are, how much revenue they're generating, how much they're driving growth. But I think it is important at this moment in time to talk about the equal weight and say that might be a better representative of the market, so to speak.
The reason I say this is because as an active stock picker, there have been a lot of stocks which have gotten drilled and a lot of stocks that have gone up a lot. This ETF is falling into the passive thing that we're all prisoner to, right, where the money flows in. I'm just saying, is there a better way that you see money flows going into just generic passive funds that you would look to, you would talk about, whether it's a screen on certain companies, to your point, that aren't impacted by the government funding issues or anything going on with the fiscal health of this country? I'm saying. So what screens are you looking at to determine, or what are you saying that you think this market's going to stay healthy?
Listen, I think the big banks all tell us flows into sectors, both retail and institutional. So we have that data. Obviously, the average investor out there listening to this probably doesn't have access to much of that data. But on the institutional side of things, you're provided to it either through your various coverage across desks or prime brokerage, presuming you prime at one of the bigger banks. And flows are still pretty strong. I mean, you had Josh Brown on yesterday, and he is sort of I don't want to say famous, but Josh famously talked about the relentless bid, and obviously David Einhorn more recently has talked a lot more intimately about the impact of passive. And I think there is this idea that market structure is different today than it was when we all started in our careers in the late 90s. That there is this perpetual or relentless bid for market coming from passive that's either going to limit downturns or accelerate moves to the upside. The one pushback on that front in relation to yesterday's conversation I would note is that doesn't mean you can't have meaningful and sustained drawdowns. The 2022 drop, as we all know, was, call it 27% over the span of a year or whatever it was, and that passive had nothing to say about any of that.
Well, what's interesting, though, so we didn't have this secular focus on generative AI, which has basically infected the top 10 names of the S&P 500. And so I think if ChatGPT came out in January of 2022, we might not have had a 35% drawdown in the NASDAQ or a 22 or whatever it was, a 27% in the S&P 500. And to your point about passive, and that conversation with Josh actually really got me thinking about things. Is like in 2014, it was a very different market structure. Passive investing, there was a worry. And I remember guys saying this back then. It's like when passive goes to active, that's when you have sharper sort of sell-offs. And we just haven't had a particularly sharp sell-off, since 2022. I think the biggest drawdown was maybe 11% or something like that. Dan, when I think about this, though, and you just mentioned the equal weight S&P, it's up 12%. Interestingly, it made a new high before the S&P market cap weight did, right? So we have an S&P market cap weight that's up 20%. It's up a little more than the NASDAQ. And I'll just say this, I think it's actually kind of bullish that Apple, Microsoft, and Google actually all underperform the S&P 500 here. So talk to me a little bit about that, because maybe the passive thing is actually turning out for it's a good thing if you're an investor who are inclined to buy dips and you're not worried about it down 20% year or something like that.
The first thing I'll note is over the last 3 months, tech has underperformed the market. I think we know that. It's been led by utilities, although utilities are not the utilities that
not your grandfather's
not your
utilities.
grandfather. Yes, I'm not sure what my grandfather's utilities might have been, but it would have been Con Ed, let's say.
Correct.
And now it's Vistra, which is one of the AI derivatives, so it's not just the 10 stocks. Real estate also has done quite well on the idea that interest rates are coming down. There's this idea that office is dead. Take a look at the chart of Renato or SL Green, and they're telling you something else. So I think it is important that the rally has broadened out. I would also note that is not in and of itself some evidence of market health or anything like that. The market was just as healthy when it was being led by tech as it is now, I would argue, being led by other names in other sectors. But as an active manager, whether you're up and down the capital structure as Solus is, or someone who's just a long short, I don't mean just, but primarily a long short investor, the broadening out is incredibly important. And getting back to the equal weight market cap index, if the S&P is up 12% for the year and the equal weight is down, as was the case at one point, as an active manager, that's just in a really difficult environment to make money, because it is obviously being driven by just a few names. And if you're benchmarked to the S&P, and the truth of the matter is, as you know, we're all benchmarked to the S&P, no matter what your strategy is. When investors and LPs come into your office, they're going to say, yeah, but the S&P. Those environments are just, and they're not frequent, but they're just impossible as an active manager. It's just your universe of names in which you can be invested sufficiently to outperform either your benchmark or the S&P, or even if they're the same, it's incredibly narrow. And so to see it broadening out is just really helpful and helps managers like us.
Are you surprised, though, the Russell 2000, it really hasn't broken out of this range that it's been in the last couple of months? It's still kind of well below its all-time highs made in late 21.
Let me ask you guys a question, particularly the two of you, because you're on CNBC more than me. Why do we talk about the Russell so much? Or small caps?
I think I'll try to answer that because I think the underperformance over the last couple of years vis-a-vis the broader market and the NASDAQ has been interesting. And I think the market's been waiting for the Fed to pivot, hopefully spurring the economy, which theoretically should benefit the most economically sensitive names that are in the Russell. Now, whether that's correct or not is an entirely different conversation. But to answer that specific question, I think that's why we focus on it as much as we do.
Listen, I'm sure many of the listeners out there have heard us on CNBC talking about, depending on how you measure it, 50% of Russell debt is floating rate, and so presumably, if you start cutting rates, I get it. But at the same time, I would ask listeners and those of us around the table, we can't name 10 stocks in the Russell 2000. I mean, maybe in the S&P 600 we could name, and it's similar. And the reason I'm asking this is, why aren't we talking about mid caps more? Because in the mid cap index, which is mid-index if you have a Bloomberg, you know all of those names. It's Williams-Sonoma, it's Dick's Sporting Goods, it's names that we talk about, that we pay attention to either as investors on or off CNBC. The Russell just strikes me as not a relevant index.
Fair. No, I think we've talked about that a number of times. Like the way that it's constructed is not necessary. However, I think broader people say, okay, if the economy is really as strong as people think, theoretically, you should start to see a participation in the most economically sensitive names.
And so the small caps are up less than 10% of the year, and your mid caps are up 12%. I mean, so they're up in line with the equal weight S&P. So I guess what I would say is to Guy's point is, like, we know that the top 100 names in the S&P 500 have no problems with access to capital. They have great balance sheets and the like. And so, but I can't tell you what the last 200 names are in the S&P 500 either, Dan.
No, you know them. I mean, maybe not the chemical names or some of the more esoteric energy drillers, but I mean, if I rattled off the bottom 100, you would know 75. You'd know 75 of them. Some weird healthcare companies, Oscar Health, you might not know. But if I read you the top 20 names in the Russell 2000, if you knew at the Royal U 3 of them, I'd be surprised.
Oscar's one of those names you don't hear that much anymore, by the way, on a side. So I've watched a number of interviews leading up to the Fed. You thought, as I did, by the way, that 25 basis point cut would probably happen. That made the most sense. Obviously, it was 50 basis points. So let's talk about that. What it seems like to me, the Fed has now said, okay, inflation's in the rearview mirror. We're throwing all our eggs at or chips at the potential for a slowdown on the job front with the unemployment rate. So there's a school of thought that rate cuts, they can somehow sort of stem the tide on that front. Is that an accurate assessment, and do you think they'll be able to do it?
Well, so the first conversation, very quickly, the first conversation is about what you just talked about with respect to the Fed and the anticipation. The second conversation is what do we do with that as investors? First, with respect to the anticipation, listen, the short story for listeners is, if the Federal Reserve, this is oversimplifying a more complex conversation, but if the Federal Reserve keeps interest rates high and the inflation rate is coming down, to oversimplify it, real interest rates are getting higher. In every academic textbook, that's deleterious to the economy. And so if you're a central bank policymaker, you want to start to reduce real interest rates if you don't think the economy needs them as elevated as they are. So while some people would say, well, the economy is doing fine. Yeah, the labor market's slowing down, but off a very high level. Yeah, the economy is going to print in the 2s instead of the 4s. Do I really need to reduce interest rates? Well, if you're a central banker, in this case, the Federal Reserve, you want to make sure that some of the damage that you're doing by keeping interest rates at elevated levels doesn't metastasize in a larger way.
Fair.
And so no one's going back to zero, but you want to try to get, in their mind, somewhere to the 3s to 4s, let's say. So what they decided to do, and this is old hat at this point, was say, we're going to get out in front of this. We're going to reduce by 50 basis points. No, there's no emergency. A lot of people like to say the last 2 times they cut 50 bips, there was obviously an emerging emergency.
Extenuating circumstances.
That's right.
Dot-com bubble and then the financial crisis.
And then the crisis. That's not what they're arguing they're doing this time. They're simply saying, listen, we probably should have cut in July. I'm paraphrasing. Let's just get 50 bips done now and be on our way. I thought they would have done 25, but that's neither here nor there. For investors, what do we do with this? This is completely irrelevant. What matters is where you're going, the skate where the puck is and all that. And at the end of the conversation, the Federal Reserve is going to reduce interest rates, assuming things unfold the way we anticipate, by 100 to 200 basis points, let's say by the end of next year. Exactly how much we don't know, they don't know. Inflation, the economy, things can emerge. But as an investor, that's what you're wrestling with, the changing risk backdrop from a tightening cycle, leaving rates high, to now rates are starting to come down. And what do I do with that as an investor? That's really what matters.
So do you believe, and I'm not saying I'm right, but I believe that there's sort of an escape velocity with the unemployment rate, with the employment picture. Once it starts to move in the way that it's moving, it typically continues to move that way. And I think to a certain extent, the Federal Reserve is okay at a certain level, probably somewhere around between 4.5% and 4.7%. The question is, will it stop there? Like, what are your thoughts on the labor? There are a lot of different thoughts here in the labor market.
Let me preface it by just saying anybody losing a job is obviously horrendous.
Agreed.
This is not to be discussed in any way as celebratory, but if you're the Federal Reserve, you want loosening up in the labor market. 3.5% or so unemployment rate is extremely low historically. There's always going to be frictional unemployment, people who are coming and going, but the Fed thinks you need a little bit more weakness in the job market. However, Jay Powell, as we all well know, decided a month ago, 2 months ago, 3 months ago, we're not willing to tolerate any more weakness in the labor market, hence the 50 rather than the 25. That said, you are right. The unemployment rate is not a stock. It does not go up 10 cents one day, down 30 cents the next day. It tends to trend. And we have leading indicators of the unemployment rate that are suggesting it's going to keep going higher. So obviously there's a big debate right now about immigration flows and how much that's impacting it, and we're not going to bore listeners, but something you might want to look at in like the Conference Board Consumer Confidence Number, that release has something that we call the labor differential. The people who respond to that survey tell a certain percentage of them tell me jobs are hard to get. A certain percentage of them tell me jobs are easy to get. The difference between the two we call the labor differential, and it overlays very nicely with the unemployment rate and continues to suggest that rate's going to continue moving higher.
Do you find it odd that money flows into money market funds increased after the Fed cut 50 basis points, new all-time record? Now I think we're sitting at 6.76 trillion in money market funds. I'm curious to get your thoughts on that. Just the money came from somewhere to go into the equity markets.
Sure.
I'm just curious your thoughts.
I'm going to dodge that question and answer another one, because I don't understand why this point that I'm about to make has not been made, to my knowledge, on TV or any of the podcasts or any of the things that we all participate in. Yes, there's $6 trillion or so in money markets. The first point is some of that's retail, some of that's institutional. So it's not just mom and pops of $6 trillion. So that's the first point. The second point is we need to normalize that by something, because numbers are always going higher. It's the Enron bankruptcy versus the Lehman bankruptcy versus whatever's going to go bankrupt today. If you normalize that $6 trillion by the value of the stock market, which is call it $50 trillion or so, depending on whether you do the S&P 500 or the Russell 1000, whatever, it's 12% of the stock market cap, something like that. That is not very high. That is not.
It's within historical norms.
It's within historical
I'm just making the
norms.
comment that the actual flow, I understand the ratio.
I'm dodging that question, and
You're
I wanted
dodging.
to make
I'm just
the first
saying,
point.
what was the reason it would be? I don't think, I was expecting 75, only got 50. Back into money market I go. I'm just saying that there's still like a safety, whether my feel, was what I thought you were going to say, is that Fed cut 50, and I don't think they see anything that we don't see.
Sure.
Things must be really bad. You know what? I'm going back in money markets.
It could.
I don't want to go in equities at these valuations.
I don't have the data in front of me, but yes, equity valuations are call it north of 20. But perhaps it's some people saying, okay, people have told me they're going to reduce interest rates for a year now. There's going to be a recession. It's never happened. Oh, wow, it's finally here. Maybe I should lock in those 4.5% rates that I can get.
And can I just make one comment about the Russell, since I'm not
your
a CBC
podcast.
person?
Make
I
all
didn't
the
get
comments
to make
you
the
want.
comment of the Russell.
Aw.
Well, I think it's important to follow is that, to Guy's point, it's kind of the real economy. But more than that is this. When it does sell off because of something macro that occurs, Russell always seems to get hit kind of the most because they're most vulnerable. That's where the stock picking, to me, they're less covered by analysts.
Sure.
The S&P, these names are covered by 72 analysts. And the Russell, some have 1, some have 4. My point is because it creates opportunity. And I know passive is dominating, but I love being able to pick up pieces and things that are impacted by fund outflows, index outflows, specifically Russell, because they are the most volatile when there are big inflows and outflows.
But 30% of the index is garbage.
Garbage to you is another man's treasure. I'm just
fine.
Okay,
That's fair.
I'm just saying in general, You talk to
But
Vinny and
garbage
Porter at
is a
Seawolf
little
Capital. You
hyperbolic.
talk to Vinny and Porter at Seawolf Capital. Most of their portfolio is Russell.
I'm not familiar. I'm sorry.
Most of their portfolio will be Russell familiar. But anyway, I'm just saying, I think it's a lost art. That's all.
Well,
I'm saying.
I want to also say, because I went and looked at the members of the S&P 500, you're right. I know like
Yes, you do.
90% of those last 200 names in there. The last thing I'll just say about the Russell or the IWM, however, like as a trader, like I'll go for that because I'll go for the beta like at some point.
Yeah.
Like I'll be playing for a breakout. If this S&P continues to kind of grind higher the way it has been, you're going to see the Russell, you're going to see the trade run out, and you're going to look for guys going to go for those.
And I'll make another point. I'll said another way. I want to make David Einhorn's point on the passive versus active thing, and I think this is important for managers like Solus. As a hedge fund, we can't be in. I mean, we don't do Nvidia, Apple. We just don't do large cap tech. But we're trafficking a lot in smaller cap stocks and mid cap stocks, and a lot of the stuff that we do is restructurings, and when that restructuring process is over, you're not a particularly well followed or well covered company, and there's tons of alpha there over time. But to reiterate or somewhat or somewhat change David Einhorn's point, one of the problems in market structure over the last couple of years is that I, as a smaller mid cap investor, can find a name that's super attractive, high cash flow, strong balance sheet, whatever it might be. And at some point I could count on the market becoming aware of my thesis. Either the sell side would pick up coverage, or I went on TV and talked about it, or something. And that ability is I think at least hindered, if not constrained, in a passive environment. It's much harder to get people to come around. We're in names right now that I think are screaming buys. Obviously, we own them, so I'm biased, but we're in them. I'm not the PM, but the team, the investment team as a whole, feels really strongly about 3 or 4 or 5 names that we own, whatever it might be, and we just know that the public will just probably never catch on, and you rely on these companies to either return capital to the shareholders, us, or something, because it's the odds that someone's going to pay attention and notice it, and it's going to grow that way, are just reduced in this environment. And it's one of the lesser discussed, although David has popularized it, one of the lesser discussed developments of the passive versus active switch over the last couple of years.
First weekend in August, the market was rather benign going into it. And then obviously August 5th happens. And forgetting about the S&P and the moves there, but the move in the volatility index seemingly came out of nowhere because volatility had not been a story at all. Turned out to be a one-day event, but was that a glimpse of what's out there, or was that just an anomaly? Because 2022 was absolutely a year of volatility. If you go back and look, there were a number of moves from sort of 16 to 35 in the VIX all that year. Since beginning of 2023, not so much. Thoughts on that?
I mean, was it the single greatest one-day spike in volatility that we've seen in modern history? Listen, we came in that day, and we don't have any Japanese exposure, but we came in that day, and obviously I, as the bigger picture guy, analyst, or is leading the conversation, but as a group, I just didn't understand. We just didn't understand what the freak out was about. I mean, obviously positioning had been built up extraordinarily high, and this was finally the moment where the BOJ was adjusting, and so positioning in the yen, which is a funding currency, et cetera, had to change. But a one-day spike to 66, a la Lehman, just seemed odd. So my answer to you is I didn't read much into it, and I don't read much into it now. So to get back to the original question, have I ever wavered? If you were going to waver, that might have been a moment to be like, well, something's going on here, and I did not.
It's hard to measure how much liquidity is really there with the dealers and stuff. Like, things can move like that, obviously. One other thing that's happening, I don't think a lot of people are talking about, although I don't watch TV as much as you guys do in terms of this stuff.
I don't watch it. It's just on in the background.
No.
I'm waiting to see if they talk about
is
me.
how positive the impact has been potentially on the consumer, on inflation, on the economy, that oil has steadily dropped here.
Yeah.
Call it from the low to mid 80s to the low 70s and high 60s now. So it's non-inflationary. It's actually disinflationary. It's positive for margins for most companies. It's positive for the consumer. Do you think is that being talked about, or is that being ignored? Because it feels like that's in the backdrop. I know China, which obviously has been one of the reasons people believe oil has been dropping, and they're doing everything they can over there to do it. But what are your thoughts on oil here? And you can go into energy stocks if you want, but just get your thoughts on it.
So we're exposed to commodities, particularly oil, and have been optimistic on them for several years. But before I get into that, no, I agree. It is not being discussed enough, the positive impact on the consumer. The primary way it's being discussed, oil in general, is through the prism of Chinese demand, as you noticed. When you watch TV or you read notes or the newspaper, whatever, it's global demand is slowing, recession's always here, oil prices should be lower. I don't think of recessions anywhere near here, and I haven't in some time. Chinese demand has clearly slowed. That's measurable. It's observable. It's clearly the primary reason why oil has fallen. But I would add to that point, the impact on the consumer is unquestionably positive. We drive a lot, 250 miles a year, 250 million miles a year, whatever it might be. So you can do the math. It's a tax cut. To oversimplify it, if it's falling for the quote unquote right reasons. Obviously, if there's a recessionary impact on it, it's different. So I think it's incredibly positive. And to the point about the consumer, I would just jump off to refer to this morning's data. The revisions to the GDP data that came out today revised up. There's an ancillary measure to GDP. It's GDI, gross domestic income. That number was revised up by about $800 billion and took the savings rate from the 3s to the 5s. So even before this was happening, the consumer was even better shape than we previously thought based on the revised data. Shocking that the government is revising data in a meaningful way. But you layer on top of this new data that we have, which is that the consumer is stronger than we previously thought, with a $20 drop in oil prices, my own views on whether that's worth it or not aside, that's just really, really good for the consumer, which is in a pretty good place. And one of the things you talked about yesterday with Josh that I wanted to repeat, and I listened to this on the way in, which is why it's
I was saying you're obsessed with Josh a little
No,
bit.
I'm obsessed with this podcast and the three great guys that. But you were talking about consumer sentiment, and Josh is correct that a lot of consumer sentiment these days is political, and one might look at the depressed level of consumer sentiment against the unemployment rate, against some of these other measures which are doing quite good, and go, what's going on here? The answer is A, politics. The second answer, of course, is prices are up 20% or something over the last few years.
Right. And I was making the same point as you, is like when I think about crude coming down, I think about inflation coming down, I think about a whole host of other things. The unemployment rate's still at a pretty low level, right? And so I say to myself, all right, so the consumer's in a good spot. 2/3 of GDP is consumer spending, and maybe that's great. The one thing I wanted to ask you about China, so the Shanghai Composite's up 10% this week alone. Crude oil's down 6%. I mean, so that's a kind of a weird little thing. You just talked about, obviously, Chinese demand's been really weak, but if you believe in all this stimulus, both monetary and fiscal, and this is going to get the Chinese economy going again, why isn't crude trading better? And I get it. I know what the Saudis just said. They're kind of, getting away from their $100 target and this and that, whatever. They want to kind of get market share back. But that seems something that's kind of curious right now this week.
Yeah. But you did hit the important point, which is what Saudi is. Now, listen, Saudi's taken, call it 2 million barrels off the market that they could easily turn back on. They're upset that other members of OPEC are not bearing as much a brunt of this, that there's cheating on the quotas, which happens all the time. So forget the $100 number. These cuts were always going to be unwound pretty soon. And I think what that story is doing is reiterating that Saudi is tired of ceding share, which as an oil investor, as an energy investor, Solus or anyone, you always knew was the risk. That you had a scenario, which has happened before, where the Saudis say, okay, we're going to try to kill shale, doesn't work, and they just turn back on the spigots, oil collapses, and as an investor, you have to bear that brunt. So this was always a tail risk that Saudi said, enough is enough, we're going to start turning back on the spigots, which appears to be happening. How fast and the rest of it is an open question. But to your point about the China stimulus, not to get too detailed, I'm not a China genius or anything, but a lot of what they unveiled was not particularly sufficiently demand focused. There was always a hope that there would be secondary support measures. The issue in China is consumer demand. The issue in China is the property market. Housing prices have been basically in a free fall for 2 years. That is you don't have the same investment vehicles in the United States that you do that you don't have the same investment vehicles in China that you do in the United States. Housing becomes a really crucial part for sentiment over there, for investment, and it's just been terrible. And so, again, my own personal feelings about what they should or shouldn't do aside, there is a holistic view, to borrow Kamala Harris's word of the day, there is a holistic view that you need to do more on the demand side of things over there. And what's been announced so far, while welcome and probably enough to hit their target of, call it 5% GDP, may be insufficient to really address the issue over there, which is one of demand.
Well, the youth unemployment rate just hit 18.8% in China. That's an all-time high. And I'll say there's no wealth effect of their stock market there. Like
nobody over there.
Nobody owns the market.
Yeah.
So it's a whole different dynamic. And I think you said it best. I think they're just trying it. It is in the property market. It continues to be in the property market. So they're trying things there. But you still, in order to take advantage of some of the stuff that they're providing, have to start buying homes, and this is not going to happen, in my opinion. So,
hey, really quickly on that. So it's interesting what Danny just mentioned, youth unemployment at 18%. I keep reading about the demographic issues that they have there, and by like 2050, they're going to have 800 million people, down from 1.3 billion. Are we focused? Is this a massive paper tiger? Like, we've been focused on China for 20, 30 years, and we keep saying, well, they're playing the long game. The long game looks really shitty right now when you think about it. And so why are the Philippines an issue? Why is Taiwan potentially an issue? The South China Sea, and guys made this point again and again. I mean, we are in we're in like a technology battle with them first and foremost, right? So this is the battle for supremacy as it relates to generative AI and the future of that and the manufacturing of that and supply chains as a matter of national security. I feel like that we're going to win this China thing, and they're much weaker. They're trying to get up to 5% GDP. And, think about this. The Fed is trying to calm down our GDP. That, like to your point, the GDI, if you want to call it, 3%, better than expected.
So to get back to Guy's point about things to worry about, if you really want to script a dystopian movie that ends terribly, it's population. And developed markets across the world are dealing with this. Japan, China,
Germany,
United States, Germany. It feeds into the immigration story.
We're doing much better, actually, if you look at
ironically,
20, 30 years.
the immigration story in the United States, whatever politics aside, from a population standpoint, is incredibly beneficial. So if you want to look at an image, just Google population pyramid for a given country.
Yeah.
And it shows you the evolution of ages over time, and it's getting higher and higher and higher, meaning the top of the pyramid is widening out, meaning you have more to oversimplify it, more retirees for working age people. And China has passed, apparently, if you think of a bell curve, they're on the other side where their workforce is expanding. And it is a problem for an economy, to say the least, when you don't have enough people working, because ultimately GDP, how much your goods and services are being produced in your economy, is a function of how many people you have working and how productive they are. Those are, if you boil everything down, those are the two things you need. A lot of people working, and you need them to be productive. And so when you have fewer people working, you need productivity to go up just to stay flat, and that doesn't always happen. So the issue in China is the issue in Germany, is the issue in the United States. And again, for all the dystopian movies we've seen for 20 years that talk about overpopulation and how are we going to feed these people, in reality, the opposite seems to be unfolding. What do we do in 20 years when there just aren't enough people? Not 20 years, I'm sorry, much longer, but...
The S&P 500 makes new all-time highs. The Dow, the NASDAQ within earshot, but gold is as well. What are your thoughts? I'm not asking you to price predict, but what are your thoughts on what it means, if anything?
Listen, I've been a gold skeptic since this started, in 2010. When we were debasing the dollar and gold was going up. The idea at the time was that the S&P's up, but you need to divide it by gold to and my
understand more, right?
My rebuttal then was my mom never opens up her Charles Schwab quarterly statement and goes, yeah, but gold.
Right.
Like that just isn't a thing. People live in a nominal world. But that aside, listen, clearly gold is telling you, as the same as it always has, that there's a demand for an alternative currency. There is, I don't think it's an inflation hedge because we don't have any, as measured by the government, any inflation anymore. But I think it's, I know we're going to get fan mail about what I just said.
Okay, Dan, I'm going to give you some fan mail right now with what you just said. You started saying at the beginning of this podcast that why should you care about the fiscal deficit and all the issues when it doesn't necessarily mean anything?
As an investor.
No, and I get that. That's fine. You can have that. But the hedge to that caring shows itself, in my opinion, in gold, in terms of the people that really understand the mechanics and the plumbing and understand this is not, quote, sustainable, say to themselves, okay, I don't necessarily, or maybe I do own the S&P also, but I'm going to buy gold here to hedge out that risk. And I think one of the things that happened with Japan, when you looked and you sat there, you're like, what's going on? The VIX went to 66. Gold is gobbling up more and more kind of money that's out there in the macro world. even of a small amount, Dan, and nobody owns it yet on the institutional side. I mean, it's really, and no one owns it. You just made a joke about your mom opening up a Schwab account. No one knows it yet on retail. It's starting to get there. So I think that, I'm not telling you what to do or look at, but revisit it in the sense of, and I don't know what your thoughts are on Bitcoin or crypto in general, but a lot of the same thesis. I know it's much newer than gold, right? But a lot of the same people believe that from a fiscal problem and an incompetence problem around the world, central banks, that's kind of how people are expressing.
I can get on board with the incompetence problem all day long.
Okay.
We can have a whole separate podcast about that. But like I just pulled up the chart of gold and of the GLD specifically. It's just easier on the
No,
Bloomberg.
because you're a gold novice. But yes, please continue on.
Well, I'm not sure the exact command for gold on the phone since I didn't bring my. But anyway, the GLD will suffice for this conversation.
dollar terms, but yes, keep
Oh my
going.
God!
No, I'm just saying you want to go gold. Let's go.
Okay,
Right.
what I'm saying is all of these problems were in existence for all of the 2010s, and the GLD. We know went nowhere for most of the time, but until 2019, when we dropped $6 trillion out of a helicopter, it went nowhere for 5 or 6 years, and all these problems were in existence. And obviously now you're in a little bit more of a unique scenario because we now have $1 trillion deficits. We're running a deficit called 5, 6, 7% of GDP, which is incredibly unusual outside of, like a depression or a war. So there are some unique reasons here from that standpoint where Bitcoin and gold would drive higher, and I think are driving gold higher. But my point again is just for 5, 6, 7 years in the middle of the 2010s, you and I had those same conversations and gold went nowhere.
What's been happening recently that has surprised you? Sort of things that you don't hear about on CNBC that are not talked about all that often. Like you say to yourself when you get home, really didn't see that coming, or I wish more people talked about. You mentioned something earlier that you wish more people talked about, but anything sort of stick out to you?
I think that the U.S. consumer,
The resilience.
there's this constant search for a reason why the U.S. consumer is just about to roll over. And Solus has a number of investments that are consumer derivatives. And I don't mean like we own TJX or something.
No,
but
understood.
Like the consumer it's travel and leisure. Deadpool just is now one of the 10 highest grossing movies of all time. There's just any number of different ways that the consumer continues to spend. Chipotle burritos are $20 each. And the resiliency of the consumer in the face of all of this has been not a total surprise to me because it was largely as I expected, but the fact that people continue to talk about the consumer always about to roll over.
So you look at the sort of the dollar stores.
Wait, you know what? I'm going to interrupt you. I'm sorry.
No, go ahead.
Because I'm going to antagonize both of you.
Wait, both of us?
Yes.
What's wrong with Danny?
I don't want to antagonize him.
You already did that.
Poke the bear.
The other thing, I'll pause in case we want to edit this, but
No, we don't edit.
okay, even better. The other thing is the resiliency of the bear argument.
Yeah. It doesn't go away.
And
I'm one of those people, by the way.
You mentioned I was on in January, and I know I listened to the podcast, so I know you've had on other people, and you've always said, oh, you were on at this date, and you were right, and you were on at this date, and you were right. The resiliency of the bear argument, I find also it's founded, it's well reasoned. You guys,
It's not. You're losing them. You lost me a few months ago. I'm kind of like just throwing in the towel because we do a decent job playing devil's advocate when we have like a nice bear on. I think Mike Wilson's told us a lot over the last couple of years, or shown us a lot. I've known Mike going back 25 years. I think he's one of the smartest minds in this business, aside from you. I think a lot of folks look at his calls over the last 2 years and they just don't get the nuance of it, right? And so I think one of the things, and we do appreciate you listening to this, and we'll have bears on, we'll have bulls on, that sort of thing. Oftentimes we're trying to tease stuff out in a way, and Guy, I think, is way too hard on himself. I've sat next to Guy for 12 years on CNBC's Fast Money. We've been doing this now for 4 years. And I think that if you are a very curious investor, if you find this intellectually interesting, all this sort of stuff, then you want to hear differing views, or you want to hear this sort of stuff. And I think folks like you, I'm sure you've gotten bearish here or there or whatever, and you kind of quickly change your tune. I've sat next to a guy now during this podcast. He's made lots of very nuanced calls about the markets, both bullish and bearish. And a lot of folks will just kind of categorize you a bit as in this camp. And I just kind of take issue with that. But like at the end of the day, a lot of things that you've discussed here today, a lot of things that you discussed back in January, I see it. Guy guy sees it, that sort of thing. But we're trying to create certain narratives and trying to help people, think about this thing in different ways. Does that make some sense? Because I think the perma bull case is also equally lazy by the same token.
By the way, the perma bull case is equally lazy.
Yeah.
Stocks always go up, so just be bullish. And by the way, fine.
Well, they do go up most of the time, actually.
They do go up.
Yeah,
I mean, that's the dirty secret of being a sell-side strategist. Just be bullish because the stock market always goes up. I don't think I was referring to the two of you
I know
specifically.
you're not,
no,
but you just wanted to aggravate us. I get you.
Well, we're trying to make for some good airtime here, but at the same time, there's this tinge of reluctance to accept.
Yes.
And again, I don't mean the two of you, just the reluctance to accept when the data is good. It's almost as if people are rooting for the U.S. to fail. For some unknown intellectual reason, people are wed to this idea that there's always this marionette behind the scenes, the Federal Reserve. The only reason the stock market's up is because of QE. I mean, this goes back, obviously, 20 years at this point. Even in the 2000s, it was the same thing. There's just a reluctance to just unabashedly say, the U.S. economy is doing pretty well. Corporate profits are doing pretty well. Companies are doing pretty well. And in that type of an environment, the stock market should go higher. Now, obviously, there's complicating factors like the Federal Reserve jacking rates at the fastest pace. And you mentioned at some point I was bearish. I was on CNBC in late 21 saying, when I started coming back on TV after switching to the buy side, saying, I don't think people appreciate what's about to come. And then during 22 and into the start of 23, I was bearish the whole time. And I was a little late. I did not pick the bottom or anything like that. But then things started to look like, okay, maybe some of my worst case prognostications are not going to come to pass. So what I'm getting at is, it's okay to be bearish. I mean, there's always things to worry about. The reluctance to acknowledge when things are working. You ask,
No, that's fair. My biggest problem with it, believe it or not, it comes from the fact that the wealth gap in this country has seemingly never been wider and continues to sort of widen out. And just my view, some of these policies put in place, these monetary policies, all they've really done is screw the middle and lower class, and they've just enriched the upper, middle, and the rich. And that continues on because who gets screwed when rates go down? The middle and lower class. And who does really well? People that own shit. And the same thing happens during inflation. Inflation becomes sort of a joke at a cocktail party that the rich people have about how much they're paying for gas. Meanwhile, it's really hurting everybody else. And that to me is, the problem that the Fed solved in terms of inflation is the problem that they created in the first place. So my inherent bearishness or negativity stems from that. The inequality to all this planning is sort of put forth. That's
I mean, listen, I agree with a lot of what you said. The one caveat I would say is, listen, the Fed was buying, we know this, the Fed was buying mortgages 20 minutes before they raised interest rates. Clearly that was a mistake, and it was a mistake in real time. You didn't need to be a PhD in retrospect. But I don't think they were solely to blame for the inflation.
No.
It's a global phenomenon.
100%.
Supply chains, we drop money out of helicopters.
I agree with that. But,
literally.
you remember, you go back and listen to Jerome Powell they were effectively begging for inflation, and I think a lot of people on the ground what do you do? What's why?
Well, they weren't begging for 9% inflation.
No,
sure.
but and that's the hubris around it, is thinking by begging for it they could somehow control it once they got it. So that that's sort of but we've talked about all this stuff many
Let me
times.
just say, Dan, we've given out a lot of longs, individual stocks on this. We may be bearish on the broader market, but we pitched tons. So I just want to say that.
I knew that this would spur a great conversation.
In our defense, no, but I also want to say we had Luke Groman on a week ago, and if you didn't listen to it, everybody should listen to it. And what he was explaining was that people are underestimating the impact that the fiscal deficit, which you don't want to look at or deal with,
That's not what I said.
No, is actually working its way into the system, right, and providing a boost. So I think for fundamental people that look at the markets, this is extraordinary times in the sense of it's never been tested. Since 2008, everything's been changed. There's no playbook. I mean, the playbook is Fed's got your back. We're going to inject liquidity around the world, every central bank, right? You try to pull it out here and there a little bit at a time. The market reacts, VIX explodes, goes higher, failed experiment, this and the other. However, we've been through a couple of these failed experiments with the BOE in the fall of 22. Bank of Japan's dealing with it right now, trying to tighten just a little bit to 25 basis points. You get that. So my point is that I think that I do believe still that bulls, and I'm not saying bullish, are underappreciating the aspect of that. And something could break there. I'm not saying it is. Something breaks there, even small. We've had like little cracks. that's what I think would be concerning. And it wouldn't impact necessarily the earnings of an S&P company on day one, but it would impact the confidence, I think, in the system. And I feel like, Dan, a lot of the market strength has been the belief, and this, it doesn't get broken, that the Fed's got your back, will do whatever it takes.
Fed does have your back.
To the point that you made, that the Fed should have only gone 25, and everything you've talked about today with GDI now and all this stuff lends itself to the Fed really shouldn't be cutting much more at all, yet the market's pricing in 75 basis points till the end of this year. So I guess we're dependent on that. We're dependent on it is what it is, and it's finding its way into the markets, and that's fine. But I do think that there's an underappreciated thing going on under the surface.
To be clear, just to repeat, I'm
making fun here, Dan.
I know you are. We're having fun. This is all fun.
Are we? Who's laughing?
I don't know.
I'm having fun.
No,
I'm having
just
fun.
kidding.
I'm sweating a lot, but I think I'm
Joe
having
Pesci
fun.
moment here to make you laugh.
But
Do I
it's
amuse
not
you?
that my point about the deficit is if I told you that Greece lied about their debt or were for 5 years before finally admitting it, there's nothing you could do with it. And telling me that the government spends too much money or that the deficit is too large or the debt is accumulating, I don't know what to do with that as an investor. That's now your point about the deficit is entirely correct. It's very hard to have a recession when the U.S. government is running a 7, 8, 9% deficit to GDP. Full stop. They're just somehow, now listen, some of that is accounting, but a lot of it is real money that's going into the world. The whole reason that $1,400 checks went out is because we'd already sent $600 checks. And I think it was Trump was like, well, we should have sent 2,000. And so Biden was like, okay, send the 1,400. And then the Democrats approved it. I'm pretty sure that's what happened. So I don't mean to suggest it doesn't matter. I mean, I don't know what to do with it on the negative side of things. It's going to matter at some point.
And
I just don't know when.
hearing that from everywhere. And I made this point a couple times. I think it was last September, so a year ago, and it was right before Byron Wien passed. And it was at this closed door thing. It was a bunch of investors, there was some strategists and some CEOs, and everyone went around the table. The question was, what really worries you about the long term? And Byron Wien said the deficit. I mean, this is a guy who's been a strategist at a top tier, for what, like 70 years or something like that. And so I think that's interesting. We keep hearing that. These are things that are very concerning, and ultimately they will come home to roost, but when? And, we had Brian Belsky on, and I think he's great. This was back in March, guy. I think it was just you and me and him. And, he was really animated. He was having fun, by the way, on this pod.
Belsky's great.
He wasn't sweating as much as you were. No, I'm just kidding.
You're glowing.
Guy, do you remember he got really animated and he made this point about like a year ago at the time when the SVB and the stuff was rolling out, and, a lot of folks got really barred up, and he was just like, listen, we have to divorce. If you're a market person and you get too wrapped up in the economy, you're going to make mistakes.
Right.
Yeah, that sort of thing. And that was to me, so what are we talking, 6 months ago? That was really instructive to me because we were drilling down on every CPI and every most favored, Fed number and this and that, whatever. And it's all a bunch of nonsense at the end of the day. Yeah, we have some market volatility in and around them. So is that a sort of view that you take also, is just like, and I think that's what you're kind of saying is like, sometimes those things that might come home to roost, or some of these intermediate term sort of stuff, it doesn't really matter for the market right now.
I think Bill Miller was the one who said, by the time you're counting the cars in the parking lot, you've done too much work. And I think on the macro side of things, that's certainly the case. And to that point, when I first started doing anything publicly, one of the first things I did, I started writing for the Big Picture blog, which was Barry Ritholtz's blog. This was back in 2007, 2008. And around the time of the GFC, at that time, and I've never forgotten this, Barry wrote a blog. I believe it was Barry who wrote a blog, and the title of it was, "Do you want to be right or do you want to make money?"
That's right.
And the point of it was everyone, it was probably about the time that Wall Street Journal op-ed had come out, where 60 people, 58 of which everybody knows, signed an op-ed saying the Fed's going to destroy the dollar. And about that time, Barry had written this, "Do you want to be right or do you want to make money?" The idea being, as an investor, one of the best things you should do is just divorce yourself from these larger arguments about who's right, who's wrong, and ultimately focus on the fundamentals. And I think, again, as an asset manager, in the case of Solus, we have lots of conversations about all of this stuff that they could go on for hours sometimes, just in good fun about what's happening here. But when we're looking at a shipbuilder or a coal company, this goes without saying for most asset managers, I assume, when you boil it down, it's what's EBITDA, what's the multiple, what's the market pricing in, et cetera, et cetera, et cetera.
Too many podcasts with talking heads. I want to make one point about that. It's kind of interesting. We have this great opportunity to sit down with someone like you for an hour and really go through a deeper dive. You know, I think we do this less, Guy, and I want to kind of kick it over to you. Like, Guy's been doing fast money for 18 years. And yeah, we talk about this jobs number or this, CPI or whatever. Guy, the bulk of what you've been doing for 18 years, and this is not being defensive, is like you are actually telling people why you think this stock is a buy, and talking about EBITDA and talking about margin. And I think they're two separate things. You agree with that?
No, we try our best. I mean, the reason why we're still a show almost 18 years later is I think people do find value. You get caught up in the minutia to your point, and that whole thing, would you rather be right or make money? I mean, that resonates with me seemingly every day, and I totally get it. But I also think there's a response. One of the things that I keep coming back to is when we started doing fast money in January of 07, I mean, think about what's about to happen in the world. And the feedback we got in the aftermath was, I wish more people warned us about some of the things that they saw that were going on that we had no idea about. And I sort of vowed that if I saw similar things, and I'm not comparing this to 08, 09, but when you saw similar things that were concerning, you would voice them and then let people make their own decisions. So the market's going to do what it's going to do, but you'd almost not be doing your job if you didn't point out some of the things that for whatever reason other people are reticent or just unwilling to point out. So that's sort of where my posture's been for the last, 14 or 15 years.
And correctly so. To get back to the point, there's a lot of data. And in the moment, it all seems super important. But the truth is the trends matter more than anything else.
With that.
And the jobs number was 50,000 less than expected, and the universe implodes, and then 6 months later the market's at a high and everyone goes, what happened? Because the number was still 180 or whatever. And as long as you're creating jobs, that's really all that matters. And why does Front Point or Seabreeze or anybody that we know, why do they have me in when I'm on the sell side? Because you say to yourself, okay, this jobs number did that, or this economic data point did this, or this earnings report said that. But what do I do with it?
Right.
What am I, as an investor, can you walk into a room, can you spend 45 minutes to an hour with an asset manager and help them think better or more appropriately about the market, at least as far as you see it? And to your point, it's not that you shouldn't obsess over these numbers in the short term, but you've got to compartmentalize, and isolate what matters. And the ancillary to that is what doesn't matter. And I always tell people, when you get married, the most important thing you can do at your wedding is give the band a do not playlist.
Right, agreed.
Nothing is more important at your wedding.
Good.
And to that point, when you're looking at all this different stuff, you watch, someone will come on TV and be like, I'm picking a name out of a hat. Casey's General Stores reported the other day, or Cracker Barrel, and they said the consumer is slowing down. Cracker Barrel,
right?
This is, in the context of the economy, this is a de minimis spending cohort by just people who happen to be driving by a Cracker Barrel on a highway. But the point is, you need to understand what matters, what doesn't matter. And I didn't mean to suggest that anyone, the two of you or anybody,
you didn't activate us. I mean, we've
been having a 45-minute conversation about it, so I think
By the way, my wife and I did sit down with a band, and one of the songs of about 5 or 6 was "We Are Family," which is one of the worst songs in history. Electric Slide and some of the other bullshit that people
I have
like.
no idea what my wedding song was. Either does my wife.
my number one do not play was September.
Yes, I could not agree with you more.
My do playlist, I said Stevie Wonder, Michael Jackson, and Prince over and over and over again.
Well, there you go. That's what I know. What my wedding song.
And it was Sinatra.
The way you look tonight.
What about you, Danny?
Now and forever.
Nice.
Look at you.
Wait, should we leave on marriage advice from?
No, we're
from
going to
Dan?
leave on the following.
Yeah.
We are family, and we love when Dan joins us. But if you heard me earlier, right at the top of the podcast, I said, "Welcome, Danny Moses." You said,
"Hi, Guy."
I said 3 and 7. Then I went to you. 3 and 7. If you missed it then, that is your record as we approach week 4 in the league where they play for pay. Now, I can do that math, as can Dan Greenhaus. That's a 30% winning percentage. That is not good. When you incorporate the vigorish, that's awful. But you're here to say, you know what, line in the sand, week 4, I got a couple games, and you're going to get back on the horse.
Let me just start with some of our stock picks that we do give out, because yesterday, Flutter, which owns FanDuel, gave guidance that they're going to do $5 billion in EBITDA in a few years, that their market share is growing in the U.S., and ahead of their earnings report, which is in November, announcing a $5 billion buyback to be spread out over a few years. Stock went gangbusters. Genius Sports, which is Obviously, they're a large client of Genius, went up, and we've been pitching those names. And it also made me realize something else. Why gamble on the games when you can just take the money and buy the stocks of the companies that benefit from idiots like me? They gamble on it. That's a whole nother discussion because it's fun in those 3 hours of time. So let's just start out by saying that, Mortimer, this $100 is going to, this is the Atlanta Falcons for not kicking a field goal with 5 minutes left. No pass interference call, but that's fine. That's yours.
Well,
Congratulations.
They did get 3 calls in their favor on that last drive. By the way, look at this $100 bill. It looks like
you don't want to know where,
like the season that
you don't want to know where that's been.
Look at this.
You don't want to know where that's been. All right, if I'm giving 2 games this week. If I go 0-2, I'm done with this forever.
Well, hold on.
Okay. If I go 0-2, I'm done. Done. You will never hear another football.
0-2,
you'll never hear a football pick from me
done
ever again.
with football picks. Okay, that's
Seattle's going into Detroit. This is weird. 4 years in a row, Seattle's played at Detroit. Not a home and home. They go at Detroit. Geno Smith's 3rd year in a row. Geno Smith is 2-0 in Detroit.
Geno Smith is still in the league?
Please
he's
stop.
Playing very well.
Playing for Seattle. He left. Everyone who leaves the Jets tends to play well. That's a whole other discussion. Anyway, here's another fact. It's Monday Night Football. Seattle, largest winning percentage in Monday Night Football history, 31-12. They don't even need to win. They're getting 3.5. I like Seattle in Detroit. The other game is the Steelers.
Hold on a second.
Yeah.
The Seahawks are getting 3.5.
In Detroit.
Road dogs. And you just routed off all their stats on Monday night.
Yeah, and they're still getting 3.5. Okay. So you think I'm missing something?
No,
Great.
I don't think you're missing anything.
Is past performance a guarantee of future performance?
Never.
It is at Solus. All right, so Steelers, the Steelers are -2 at Colts. I love the Steelers. I ride them. Best defense in the league. Anthony Richardson still unproven. Steelers will find a way to win that game, hopefully by 3. Lay the 2 with the Steelers at the Colts. Those are my 2 picks this week.
I'm going to take the Lions for 100.
No, you keep that. You can give it to me next week on air.
Okay.
Very good.
Quentin Nelson, by the way, in that Saquon Barkley draft, the best football player in that draft was Quentin Nelson, who was a guard. If I were the Giants, that's what I've selected number 2 instead of Saquon, but that's neither here nor there. Dan Greenhaus, we love having you on. Please come back. I don't know if it's going to be before the end of the year, but definitely early next year. You remain the man.
This was wonderful. Thank you for having me.
Thanks, Dan.
Only Dan's and Guy.